Hi, everyone. I'm Rowe, U.S. Regional Director of Research. Welcome to our Research at Citi podcast. Our guest today is Dan Tobon, who is our head of G10 FX strategy. And most recently, Dan, you published a must-see, that's one of our banner publications here at Citi, on wildcards for 2026. Welcome, Dan.
Thanks for having me.
Maybe what we should do is start off and maybe you can explain what the Wildcards publication is and what the expectation for it is. What do you do with it? And how should clients be reading this publication?
Yeah, of course. It's we get a lot of questions from clients, both corporate and investor clients, about what are those tail risks that keep you up at night that maybe they're not a base case, but there's still some probability of them. And if they were to happen, it's a low probability but huge impact type scenario. So we got together across all of research, across different products in equities, rates, FX, credit, et cetera, along with our economists. And we started having these brainstorming sessions to figure out what could be some interesting scenarios that fit that description. Lower probability, but very high impact. And across the entire research department kind of came up with some potentials here for things that we're focused on. I think one of the main things I would point out is these are really meant to be timely. So, there's all kinds of wild cards that you could have put on a list 10 years ago and could still be on a list 10 years from now. We really wanted to make these things that are, if they're going to happen, they might happen this year. There's things that are going on in the backdrop, which could trigger some of these from becoming wild cards into actual base case scenarios.
And I think I'm not giving anything away by saying one of those wild cards actually sort of came to fruition just after we published wild cards. And we'll probably touch on Iran a little later on. And maybe what we should do now, Dan, is describe a couple of the wild cards that you and the team identified for the publication and give us an example of those.
Oh, we might as well just stay on what you touched on, which was Iran, which
okay.
is, that
sure,
was one of the ones that sadly it did actually come to fruition within days of us publishing the note, and it was the risk of an attempt at regime change or a much more increased conflict that could see massive disruptions to oil flow. And in fact, that is what we've seen over the last couple of weeks. And I think that ties into the idea, these aren't really kind of out of left field type ideas. These are themes or wild cards that it's a low probability, but a very real probability nonetheless, especially as we are moving into an environment of greater global fragmentation. And that was actually one of the themes that a lot of the wild cards by chance ended up falling under, right? Is this shift that we're going from kind of a unipolar post-Cold War US hegemony world into one of greater fragmentation, a lot more nationalism. And that starts creating a lot of global tensions, which then lead to a lot of these wild cards becoming more realistic scenarios.
When you and the team were looking at these various wildcards and scenarios, and it's not happening right now, but one thing that I noticed about last year is that we had a lot of idiosyncratic event risk, and I didn't feel like volatility in particular was shooting up or going high. It seemed to have become a bit somnambulant. In other words, the message almost felt like the financial markets were telling us that they're resilient and they can handle most of these events. How are they playing out right now? And also, does one event happening, like one wild card happening, actually suggest that it would affect other wild cards? In other words, are there knock-on effects between these wild cards? Or are they truly idiosyncratic?
Yes, and I think last year, you're right, there was a very surprising amount of resilience across asset markets. And ultimately, it was a good reminder that at the end of the day, you're trying to figure out what is the bottom line impact for earnings, what is the growth impact, the labor market impact. And I think that there was some offsetting themes that obviously we had a lot in terms of trade and tariffs, but we also had a lot of positives, including a lot of very big spend on the AI side that basically ended up helping to offset some of the growth impacts from tariffs. One of the things that makes a shock like the oil shock so significant is that there is no hiding. It starts feeding through into absolutely everything. And so something like the Iran wildcard does then have potential knock-on effects that does make some of our wildcards more likely and then some of the other ones less likely. And so maybe I can point out two, which I think are quite interesting. One that becomes more likely is a wild card where we basically thought about the Monroe Doctrine and took it to an extreme. And in this scenario, it's basically what would happen if the US blockaded all of the America's oil exports that would go to the rest of the world in an attempt to kind of keep some energy resilience more towards the Americas. And I think back to, it was only 15 years ago that the Brent WTI spread, the spread between oil price in the US versus oil price in Europe, that spread got to around $30 because the US at that point was producing a lot of oil without exporting it. Right. So if we moved into a world like that again, that the oil moves are becoming so extreme that the US does create a blockade like that, that's going to have massive repercussions globally, but also create different playing fields from an energy perspective for different regions. That then ties into one of the other wild cards, which was what happens if we were to see European growth that looks a lot more like US growth, right? 2.5% plus real GDP growth. There was a lot of excitement about the fiscal spend that was going to be coming in through Europe and potentially a lot of reforms that could boost growth now. Well, now we're worried about higher premium and energy prices. That's especially vulnerable for Europe, which doesn't have energy independence, really relies on energy imports originally from Russia. That's become more complicated. From the Middle East, that's currently complicated. And from the US, which those flows still continue, but obviously there are some US-European tensions. So absolutely one wild card could then have, if it actually comes into fruition as the Iran one did, does now have implications for the other wild cards.
And Dan, I want to talk about a couple more, but before we go there, one thing that I've noticed with the Iran conflict is that duration is becoming a big issue. How long will this go on? And the idea that if it's short-lived, the global economy, say, would be more resilient to that. But as this thing drags on, it's going to have a more pernicious effect on the global economy and on markets. Is that something that you also and the team identified among these wild cards? I know that Dirk Willer often likes to fade the event risk tactically when he's looking at his macro strategy. Is that something that was considered as well?
Yeah, I mean, I think for the wild cards, we were a little more focused on the risks themselves versus maybe how you tactically trade them. A little bit more so, kind of if this has big picture implications, what would those be? I also come from the same camp as Dirk that historically these are fades. The trick with fading is always the timing, right? We tried fading the Iran conflict last week. The timing didn't work out well, but we are still technically in that window that our commodities team has identified as, we're still in a situation where this can be resolved. If oil flow starts coming back by the end of the month, we can avoid a lot of the more serious risks that could happen if this becomes a lot more prolonged. And I think that what you're seeing in this curve flattening in a lot of global curves is kind of reflecting that. Okay, for now, this might have a little bit of an inflationary impact, but it's not going to be a whole full hiking cycle across the board because it starts having a growth impact over time. And so, yes, a little bit backing up in the front end, 2 years, but certainly still an expectation that this will have a growth effect at some point if it continues. And I think Europe here is another interesting one. How many times did we see Trichet hike for the ECB, both in 2008 and 2011, because oil was going higher, despite the fact that Europe, in both cases, was actually going into a severe economic recession. Hiking into economic weakness, I think, has got to be clear that it's not good policy. And yet we're already starting to hear language of central bankers forgetting lessons learned and talking about more hawkish paths. So at least something that we'll have to keep a close eye on.
And Dan, I think one of the scenarios that you looked at was this idea of U.S. pursuing its kind of U.S.-centric agenda and what the impact would be to foreign holdings of U.S. assets. Tell us more about the risks here, and do you think that they're prevalent? Also, all things considering now, we have this Iran conflict.
Right. So we really split this up into two risks, because there's the risk that is the one that you hear a lot more about in the media, which is that foreign investors will actually begin to unload U.S. assets, both equities and fixed income. This has really been a narrative that has exploded over the past year, especially after Liberation Day. That actual risk to us is quite low. And it's because at the end of the day, a lot of these savings really don't have another market that they could easily move from if they were to leave the US. It's just a very unique market. And so while there have been a lot of concerns about these flows leaving, the reality has been a lot less significant. You certainly see some examples of countries maybe rotating a little bit, but this isn't really happening on the grand scale that investors were originally worried about. And so the more likely risk related to this is actually more the sentiment factor, which is if the market believes that there's going to be a lot of outflow from the US, then as an investor, you want to get ahead of the crowd. And so maybe this can start having some self-reinforcing mechanism that leads to a sell-off in US assets. We would view that as more likely than an actual divestment from US assets. Now, the effect in the short term is the same, right? US assets go down in price. But how far they go down in price and how long that lasts, it really does matter if it's just a sentiment trade versus an actual divestment trade. So the higher probability risk ends up being that is that sentiment trade. And we've seen bits and pieces of that. But one thing I would flag is let's look at the dollar, which is the asset that was supposed to be the most vulnerable to this global rotation out of the US. The moment you start getting risk off again, geopolitical tensions increasing and uncertainty becomes the norm, you're starting to see a lot of dollar strength again. And so we had an out of consensus dollar for the view for dollar strength this year, and that's actually starting to manifest itself as the world kind of recognizes, this still remains a very turbulent time, and the dollar is still a relatively safe place to hide in that situation.
This is a little bit of a tertiary question to the one on wildcards, but I had a discussion with one of our counterparts in wealth and was wondering how you would identify a risk-free asset in this current environment. And so, with long end treasuries coming under pressure a bit from fiscal, gold overpriced here. And this actually goes to whether you see more flows into the US or not. Do short dated treasuries still hold allure as a risk-free asset for the world, do you think, under these circumstances?
Yes, I think absolutely that, especially, very, very front end that you could just keep rolling through the scenario should still do quite well. Ultimately, you brought up gold as a great example. Gold has been doing very well since 2022, and yet actually has underperformed, I think, relative to expectations during this more intense geopolitical climate. Ultimately, the issue ends up being one of positioning. Whatever is owned, when you have a volatility shock, those positions get reduced. And that's why gold actually has underperformed. And if you recall, you think back to, I think it was October 2008, gold actually took a 30% decline quite rapidly because it was owned and because people needed to reduce positions. So one of the ways that I always try to think about these, what could work well in a world where everyone is unwinding, is basically the things that were most sold. And I think that's exactly what we're seeing now. The issue is that the world was long assets across the board, whether they were commodities, fixed income, equities. And so everything seems to be under pressure. One of the things that wasn't owned because of concerns was actually the dollar, and that's performed really well. And I think, as you mentioned, very front end treasuries, because we still have confidence that those are priced based on the Fed. As long as that relationship holds, those will always remain a viable source of safe haven as well.
And maybe we can switch to another wild card, which is obviously a popular one, asset bubbles. I think there was a lot of focus early on about whether AI-related stocks, hyperscalers, were in bubble territory. There's also an argument that we will see continued growth with AI expansion and adoption. Private markets have also entered the fray in terms of whether they're overvalued or whether this is a moment when we might see a pullback in private credit, private equity. How are we viewing that wild card? And is that wild card been exacerbated a little bit also as a result of recent events?
Yeah, more so from the AI disruption maybe than from the Iran thing. When we're thinking about the risk in the credit market, it's a bit twofold. One is specific to software, where software is about 20% of the loan market and historically was viewed as relatively safe from a cash flow perspective. These companies were supposed to last for a very long time. We really don't know how disruptive AI is going to be, but certainly the progress, at least from my perspective, the speed at which things are changing, you have to have some probability that there could be some major disruption. funny enough, the one thing that could hold back some of that disruption is actually the energy needed to run all of this AI. And as energy prices go up because of the conflict, maybe that's easing some of those concerns that it'll take a bit longer while the energy dynamic and infrastructure is built out. But at the end of the day, the key thing remains is we don't really know how much disruption is going to hit the software industry. That is a big chunk of the loan market. And so that uncertainty is going to keep some pressure on it. The other side of it is just in general, there's some opaqueness to private credit. And so I think there's a lot of uncertainty in terms of where the exposures really lie because it's not as transparent as maybe some other asset classes. And so, of course, there's always that concern. Well, for all those of us that were around the great financial crisis, it was something small that seemed idiosyncratic and contained that started spilling over into other assets. And eventually we had a whole banking crisis. That's always the concern when we're looking at securities where there's some opaqueness to them, some uncertainty, and there's that fear that it has a domino effect. I think the domino effect risk we see as being a bit lower. The banks seem to be in a better position. They're less exposed to this. But certainly within the asset class itself, this AI disruption theme is going to be really important for how this continues to get priced.
But you would still classify it as a wild card. In other words, something that is more a tail risk scenario.
Well, I think that at the moment, if you listen to what our equity and credit folks believe, there is still some value in software. It's not like these software companies are going to go to zero. Right. And so for the time being, it's really about figuring out the right valuation. The thing about software where it becomes a little bit more of a tail risk is what value is going to be recouped. If most credit, you're getting at least 50 cents on the dollar, whatever it may be, when it's the value is IP, and suddenly the IP's value is lost because AI can do it, that recovery rate might be significantly lower. And if that's right, that's really not priced in yet. So figuring out where those recovery rates are going to land that will take some time. That's what kind of leaves it more as a tail risk versus base cases. That is where we really ultimately going to land here on these software companies.
Got it, Dan. And maybe we can talk a little bit, we can switch over to Europe here for a bit. There's a wild card there. It's kind of funny for a wild card to be a success story, but a wild card in regard to Europe where you could see potential US-like growth trajectory in Europe. And I think you were talking about that earlier on in the podcast. What are the implications for that? And is that wild card less likely now, given certain circumstances?
Yes. I mean, last year was all about optimism in the EU. That started with real attempts on the fiscal side to alleviate a lot of the defense spending that never took place, that maybe should have took place. Germany separately has been dealing with major manufacturing issues as it's finding it difficult to compete with China. And so Germany was one of the first ones to really take advantage of the potential room to increase their fiscal spending as a way to boost their growth. Now, the question really becomes, can we get to a higher growth? Because even with the fiscal spend on defense, that's a good development for sure, and that has a positive growth impact. But that's not going to get you to the type of growth that's going to create a US-like engine. That's more of a momentary 2027 kind of story. Then we kind of flatline on that growth. So the question is, can we really get this massive manufacturing recovery? Maybe we start seeing more reforms as well on the labor market side, things like that. Europe has the potential. The potential is there for this kind of growth. There are headwinds to it. There are structural dynamics to it. So, we hope that we can get over those. But obviously, one of the key elements for Europe does remain that energy dynamic. Unlike the US, it is not energy dependent, and it doesn't have as clear of channels to import energy the way that maybe China does through Russia and the Middle East and the like. So a higher bar, I should say, to be able to achieve this one now that we're seeing those energy shocks. And it was already a little bit of a high bar because it effectively requires a more unified Europe versus, we still see some issues with political risk internally, inabilities for a real fully unified EU to make the changes that it needs to. The potential is there, though, and I'd like to be optimistic for it, but obviously from an investment standpoint, we're not quite there yet, and this energy shock is going to hurt.
Is the European wildcard also dependent or not dependent on resolution of the Ukrainian-Russian conflict, or is it actually incentivized by it, for instance?
Yeah, it's independent for sure. The resolution would help. A big way in which the resolution would help is actually on the fiscal side, because right now it is Europe that is basically paying for the war, and if that capital could then be used as part of productive defense spending versus just arming, and at the end of the day, arming with U.S. weapons, right? So it's still you're still selling euros to buy dollars to buy US weapons. That's still positive for US earnings. That's still positive for US productivity. It's not really helping the EU that much.
Mhm.
If one of two things happen, right? If the war ends, that capital can then be used in more productive ways. Or if the war continues, but the EU is actually able to build an industrial military complex from which the supply is now coming from Europe instead of the US, these could be a lot more productive towards growth. But we're not counting on that necessarily as part of this wild card.
And Dan, real quick, have I missed any wild cards or any other ones you might want to mention?
I would just mention the Japanese carry trade, because funny enough,
Mm.
to start this year, I had more client calls with non-FX clients than with FX clients, because everybody wanted to hear about the risk of the end of the yen carry trade. And, we're not there yet, but this might be a year that we finally start seeing the locals moving more into their own domestic fixed income market, their own JGB market, now that yields are very attractive. And Japan is one of the biggest buyers of
Yeah.
global fixed income. So that kind of shift where they're moving more towards domestic assets from foreign assets at the size of flow that they're at can absolutely have an effect. So it's definitely something to watch.
Dan, thanks very much for our audience. Thank you for participating. And also look for the wild cards must see on our public site. It's available for everyone to read. Thanks again, Dan.
Thanks, Rob.
This episode of Research at Citi was recorded on Tuesday, March 17th, 2026. I'm your host, Rob Rowe.
This podcast contains thematic content and is not intended to be investment research, nor does it constitute financial, economic, legal, tax, or accounting advice. This podcast is provided for information purposes only and does not constitute an offer or solicitation to purchase or sell any financial instruments. The contents of this podcast are not based on your individual circumstances and should not be relied upon as an assessment of suitability for you of a particular product, security, or transaction. The information in this podcast is based on generally available information, and although obtained from sources believed by Citi to be reliable, its accuracy and completeness are not guaranteed. Past performance is not a guarantee or indication of future results. This podcast may not be copied or distributed, in whole or in part, without the express written consent of Citi. Copyright 2026 Citigroup Global Markets, Inc. Member SIPC. All rights reserved. Citi and Citi and Arc Design are trademarks and service marks of Citigroup Inc. or its affiliates and are used and registered throughout the world.